Lesson 13. What causes the distress that interferes with trading decisions? The fields of behavioral finance and neuro-economics have illuminated how emotions affect financial decisions. If I start my day telling myself that I must make at least several $1,000s each day, then I'll now perceive the slow market as a threat to my trading goal. The narrow, whippy action translates into a lack of opportunity, a lack of profit, and a lack of success. It's easy to see, with that mental framework, how I could wind up viewing slow markets as threats to my career. It's no wonder that the slow market would trigger my distress and overtrading. So how do we change the filters that turn normal trading experiences into abnormal events? The rule is simple. If you don't know your filters, you cannot change them. Becoming aware of the expectations and beliefs that shape your perception is essential to the process of shifting your perception. Here's a simple exercise that can aid you in becoming more aware of any distorted perceptions you might hold. Every time you experience a distinctly negative emotional reaction to a market event, consciously ask yourself, how am I perceiving the current market as a threat? This turns your attention to your perceptual processes, giving you a chance to separate perceived threats from the real threat. The key here is to distinguish between actual threats, markets that truly are not behaving according to your expectations, from the perceived threat that requires reflection about markets and personal assumptions. Once I saw that the trade was proceeding normally, I was free to challenge the filters that were leading me to become nervous about a good trade. When you think about your thinking by adopting the perspective of a self-observer, you no longer buy into negative thought patterns. Identify the perceived threat. Turn the perceived threat into an opportunity. That is a two-step process that addresses the true cause of emotional reactions that distort trading decisions. By keeping a journal specifically devoted to your thinking and perceiving, you can structure this two-step process and turn it into a habit pattern that you activate in real time. When you talk or I am about the day's trading, pay attention to how you describe the market. Good, bad, quiet, active. Listen especially for the tone of your descriptions. Your tone and language often give away whether you're in tune with markets or fighting them. If you become caught up in what you think the market should be doing, you're most likely to fight it when it does something else.